Okay, let's unpack this. We are diving deep into the mindset of a highly concentrated investment manager. We've got a thick stack of their reports here, and they cover that just whiplash period of 2022 and early 2023.
That period was, I mean, a true test for any capital allocator, wasn't it? You had traditional benchmarks failing, macro uncertainty was just completely dominant.
So what's our mission here with this deep dive? What are we trying to figure out?
We're basically trying to reverse engineer their core philosophy. How do they find those few high conviction names, and how do they insulate themselves when the global economic landscape goes completely sideways?
And crucially, what they learned from both the big wins and the famously decisive exits.
Exactly. The wins and the losses.
That sounds like a fascinating look at disciplined investing during a crisis. Let's start with the absolute foundation, though. For most investors, I mean, for me, risk is just volatility. The stock goes up, it goes down. They see it differently, right?
They are crystal clear on this, and it's really the bedrock of their whole approach. They define investment risk not as volatility, but as the probability of permanent loss of capital.
Okay, so break that down. What does that mean in practice?
It means they aren't worried if a stock drops 30% in a market panic, as long as the underlying business value is, still intact.
They're only worried if that drop reflects real, irreversible damage to the company.
Precisely. Damage to its ability to generate cash flow in the future. That's the only risk that matters to them.
And the backdrop for this intense discipline in 2022 was just pure chaos.
Oh, absolutely. It was a lethal cocktail of forces.
Mhm.
You had global inflation hitting levels not seen in decades.
Which forced the central banks to hike rates like crazy.
The most aggressive hiking cycle in years.
Yeah.
Which, naturally creates immense uncertainty about a recession.
And on top of all that, you have the war in Ukraine. Supply chains are still a mess, geopolitical tension.
You had a market where uncertainty, not fundamentals, was really the driving force.
So how does a firm that's built for the long term navigate an environment like that? They're famous for concentration, right? They only hold a handful of names.
Correct. The core philosophy is just deep conviction. Find durable, high-quality businesses and stick with them. The substantial majority of their portfolio is consistently in a very small number of companies.
How small are we talking?
Usually limited to about 8 to 12 core holdings, liquid, listed, large-cap North American companies.
To invest with that level of concentration, I mean, that requires serious conviction and, maybe more importantly, a truly perpetual time horizon. You can't be thinking about the next quarter.
And that brings us to their critical structural advantage. It's a closed-end fund structure, Pershing Square Holdings, or PSH.
Right. Unlike a normal fund where investors can just pull their money out.
Exactly. PSH has what is effectively perpetual capital. They are not beholden to short-term redemption demands from investors.
So no investor liquidity demands hanging over their head. What does that practically mean when the market crashes, like March 2020 or parts of 2022? Do they just hold their breath?
It means they are never a forced seller.
Yeah.
Ever. When other firms are scrambling to raise cash, often selling their best assets at terrible prices, this manager can be calm. They can assess the situation and, if anything, use cash and their access to low-cost debt to actually go on offense.
And they use debt strategically.
Oh, very. They fund about 19% of their total assets using long-term bonds. We're talking laddered maturities all the way out to 2039. And they locked in a weighted average interest rate of just 3.1%.
Wow. So they see that low-cost debt as a competitive advantage.
The huge lever for generating returns, especially when volatility picks up.
Okay, now we get to the really clever part, the asymmetric hedging strategy. This isn't just, buying some insurance. It's a precise mechanism.
It's highly calculated, it's opportunistic, and frankly, it's brilliant. The manager became intensely concerned about inflation building up way back in late 2020, well before most people. So they implemented an interest rate swaptions hedging strategy.
Interest rate swaptions. That sounds incredibly technical. Can you break down for the listener what that is? Why is it like inflation insurance?
Sure. So think of it like buying cheap long-term insurance against rapidly rising interest rates. A swaption gives them the right, and this is key, it's not the obligation to swap fixed interest payments for floating ones at a set time.
Okay, so if interest rates spike because of inflation.
The value of that right just explodes upward. They invest a tiny amount of capital to potentially generate a huge, huge return if that negative event happens.
And the financial results are just staggering. What were the total proceeds from these hedges?
Since late 2020, and this includes their earlier COVID-19 hedges, this whole program generated more than $5.3 billion in total proceeds.
5.3 billion, and what was the total cost?
Get this, a total cost of only $446 million.
That is just an astronomical return. But here's a question. Doesn't focusing so much on these high-level macro bets, which are speculative, doesn't that divert attention from the fundamental stock research that they say is their focus?
That's a fair challenge. The way the firm sees it, it's a dual strategy. The core job is always finding great businesses. But the hedges act as a safety valve. In 2022, they were critical.
How so?
Well, those gains meant that PSH's net asset value declined by only 8.8%. It dramatically cushioned the blow and helped them crush the S&P 500, which fell, 18.1%?
So the argument is that by using these tactical hedges, they get the dry powder and I guess the mental peace to keep the long-term core strategy intact.
That's it, exactly.
All right, here's where it gets really interesting for me. When conviction breaks, I mean, even the most disciplined managers make mistakes. But this firm seems to be defined by how decisively it acts when new information comes to light. And the abrupt sale of Netflix in 2022 is a legendary example of this.
They moved with shocking speed. They sold the entire investment, which they had only bought a few months earlier, in April 2022. And that quick exit, it resulted in a loss that cut the fund's year-to-date returns by 4 full percentage points.
A 4-point loss is significant. I mean, did the firm address the internal pressure that decision must have caused? Or was the mistake just swallowed as a cost of doing business?
They handled it with what I'd call radical transparency. The original thesis was all built on Netflix's predictable subscriber growth and the operating leverage of a pure subscription model.
And then growth stalled.
Growth disappointed, and Netflix announced huge plans to introduce advertising and go after non-paying customers. This just fundamentally altered the entire business model.
So the uncertainty, the new variables, it invalidated their ability to forecast.
Precisely. The reports state they lost confidence in their ability to predict the impact of these changes. Things like future subscriber growth, revenues, and especially operating margins. They couldn't predict them with the sufficient degree of certainty they need for a core holding.
So the lesson they took away was, act promptly when new information is inconsistent with your original thesis.
Yes, and that is so difficult for any investor to do. To just admit the mistake, take the 4% hit, and move on.
It wasn't the only big exit that year either. They also sold Domino's Pizza.
That's right, DPZ. But here, the situation was different. The business was actually performing well. The 3-year stacked growth hit 17% in 1 quarter.
So why sell a winner? Was the thesis broken there too?
No. The thesis was largely successful. The problem was the valuation became, well, untenable. Despite the great performance, the valuation soared to more than 28 times their estimate of next year's earnings.
28 times forward earnings for a pizza company. That sounds rich.
It is. I mean, to put that in perspective for you, that's closer to the valuation multiple you'd see for a high-growth software company, not a mature global restaurant chain.
Yeah.
The market was just overpaying for that predictability.
So they took the cash.
They exited simply to raise cash for other opportunities that were popping up in that volatile market. It was a classic capital allocation decision based purely on relative value.
So even when you own a great house, if the neighbor offers you an absurd price, you take the money and go shopping somewhere else. Pure discipline.
That's a perfect analogy.
Let's pivot to the companies that stayed in the portfolio, the core holdings. What are the defining characteristics that a curious learner listening to this should look for in a company that can thrive in this kind of inflationary, uncertain climate?
The unifying theme is pretty clear. They look for simple, predictable, free cash flow generative, highly durable businesses. And above all else, businesses that possess powerful pricing power. In an inflationary world, that is probably the single most important attribute.
Walk us through how some of their portfolio companies embody this inflation fighter quality.
Okay, let's take Chipotle, CMG. They see it as having tremendous pricing power. Why? Because of its perceived high food quality and, this is crucial, a customer base that over-indexes to higher-income consumers.
So customers who are less sensitive to a price hike on their burrito bowl.
Exactly, and the proof is in the numbers. CMG grew same-store sales 8% in 2022, and it was one of the few restaurants to successfully expand its margins to almost 24%.
And they still have room to grow.
A massive, predictable growth runway. They expect to more than double their restaurant count to 7,000.
Okay, that checks the quality and pricing power boxes. What about the ultimate capital light model?
That would be Universal Music Group, UMG. They call it a rapidly growing royalty on global music consumption. It's an inherently capital light business. I mean, once the music is recorded, the cost to distribute it is basically zero.
And they expect solid growth there.
They expect revenues to grow about 10% annually for well over a decade,
Yeah.
and UMG has actually been outperforming its own guidance. Organic revenues grew 12% in 2022. It's just a cash flow machine.
And in travel, Hilton Worldwide, HLT, seems to fit this mold, even though travel felt so chaotic during the recovery.
Hilton is a great example. It's an asset-light, high-margin, fee-based model. They benefit directly from inflation. They earn fees based on rising average daily rates, or ADRs.
And hotel rates have surged.
Surged
Yeah.
10 to 15% above 2019 levels. And since Hilton doesn't own most of its hotels, its corporate cost base is pretty stable, so higher rates flow right to their bottom line. The report says they are well-positioned to benefit from inflation.
We see that same powerful franchise model in restaurant brands, QSR, which owns Burger King, Tim Hortons, and Popeyes.
It's the exact same mechanism. QSR generates high-margin royalty fees from franchisees. So when the franchise raises prices to cope with their local costs, that boosts the corporate top-line revenue, while the corporate cost structure is much less exposed to those same pressures.
So the key takeaway for you listening isn't just to buy hotels or fast food. It's to look for these asset-light businesses that can pass through inflation automatically because they charge a fee on rising revenue.
That is the essential insight. These models protect margins in a way that heavy, asset-intensive businesses just can't.
And finally, we should touch on share repurchases. It's not just the companies buying back stock. The fund itself is, too.
That's right. It's a double compounding effect. As a result of both PSH's own buybacks and its company's programs in 2022, shareholders look-through ownership of the portfolio increased by 8.2%. It's a constant way to enhance intrinsic value.
Moving to the macrosphere, the firm is pretty unique in its willingness to engage publicly in policy debates. Most notably during the U.S. banking crisis in March 2023 after the SVB failure.
Yes, this is where their policy voice becomes very active. During that crisis, the firm advocated very publicly, even on Twitter, for an immediate temporary guarantee of all uninsured deposits.
To stabilize the whole regional banking system.
Exactly. And their reasoning wasn't just about calming the stock market. It was about protecting the credit lifeblood of the broader economy.
What was the specific warning they issued?
They gave a very stern warning that the U.S. economy relies heavily on regional banks for crucial lending, especially in commercial real estate, where they make about 70% of the loans.
And the uncertainty about deposits would hurt that?
It would increase their cost of capital, potentially triggering a broad credit crunch that could severely harm the economy.
They also spotlighted a really critical technical accounting loophole that made these banks so vulnerable.
Yes. They pointed out that GAAP, the accounting rules, lets banks value their held-to-maturity securities at their original cost, not their true market value.
So it allowed them to hide huge losses from rising interest rates.
It created a misleading perception of financial strength. They noted the industry was sitting on reported mark-to-market losses of about $620 billion on these portfolios.
And they justify sharing these views publicly because they believe it's more helpful to hear from active market participants with capital at risk rather than just, unconflicted pundits.
It speaks to accountability, doesn't it? When you have billions of dollars riding on the stability of the system, your opinion carries a certain weight because you have real skin in the game.
Now, despite all this success, the PSH structure has this persistent headwind, the NAV discount problem.
It's a major structural challenge for them. I mean, despite an exceptional 25.1% compounded NAV return over the past 5 years, massively outpacing the S&P 500's 9.4%, PSH shares consistently trade at a wide discount to their net asset value.
And that discount actually got worse.
It widened to over 33% in late 2022 and early 2023.
That has to be frustrating for management. They're earning these fantastic returns, but shareholders aren't getting the full benefit. What are they doing to fight that?
Well, they fight it in two ways. First, through opportunistic share buybacks, which have added about 1.2% per year to NAV returns since 2017. But second, they're exploring much more dramatic options. They're looking at potential transformational transactions that would effectively make PSH part of a U.S.-listed company.
With the goal of just eliminating that structural discount entirely.
Exactly.
Yeah.
And potentially unlocking a huge amount of value for their shareholders.
So, After all this, what does it all mean for the long-term investor looking at these sources? We've seen a really clear philosophy: the disciplined use of perpetual capital, a relentless focus on high quality businesses with pricing power, and the courage to take big, concentrated bets.
And just as crucially, the intellectual honesty to decisively cut a loser when the data changes. All of it protected by those brilliantly effective asymmetric hedges. The entire strategy is designed to maximize long-term intrinsic value growth, even if it means you have to endure some short-term paper losses.
That brings us to our final synthesizing thought, which looks to the future. Their recent reports specifically flag a massive emerging risk: artificial intelligence.
They absolutely recognize that AI is changing the landscape. They state that AI is likely to disrupt many businesses, including ones that until now seem to have impenetrable moats. They're working diligently to understand what this means for their portfolio.
And that leaves us with a provocative thought for you, the listener, to mull over. Given this manager's explicit strategy of seeking simple, predictable cash flows backed by what they call impenetrable moats, how will the increasing pace of disruption from AI challenge fundamental investing? Will it force investors to constantly reevaluate whether a business mode is truly impenetrable or if it's just temporary? This shift from predictability to constant adaptation is a new challenge for everyone.